Crypto has become one of the most sought-after ways of investment in the last few years. And the recent pandemic has triggered a ripple effect that has pushed more people and businesses to trade crypto as their primary investment choice. The crypto day traders would agree to the fact that it shares many aspects from the century-old ways of investing in a business through buying stocks. However, even today, many newcomers ask one question as they begin to understand the dynamics of the developing crypto market. Which is a better investment? Stock or crypto? And in this video, we will study both and make an attempt to find out which one is better. Before we start though, if you are new to the channel, I would love to hear your thoughts at the end of the video, so make sure to comment what you think, leave a like on this video, and do subscribe to the channel. That being said, let's dive in. Let's start with stocks. A stock is a fractional ownership interest in a business. It's easy to lose sight of this, especially if you become overwhelmed by the wiggling stock prices and the potential for profit. As a legal ownership stake in the business, the stock gives shareholders a claim on the assets and cash flow of the business. These back your investment and provide a basis for its valuation. Why stocks rise and fall? A stock price moves as investors assess the future success of the company. While investors may become overly optimistic about the stock in the short term, the stock price ultimately depends on the company's ability to grow its profits over the long term. That is, a stock rises in the long term due to success of the underlying company. For a stock to be a successful investment, the underlying company must perform well over time. Crypto is kind of different. Generally, cryptocurrency is backed by no hard assets, specialized stablecoins being an exception. And that's the case for the most popular crypto coins such as Bitcoin and Ethereum. A cryptocurrency may allow you to perform certain functions, such as sending money to another person or using smart contracts that automatically execute after specific conditions are met. Why cryptocurrency rises and falls? Because cryptocurrency is backed by assets or cash flow, the only thing moving crypto prices is speculation driven by sentiment. As sentiment changes, prices shift, sometimes dramatically. So cryptocurrency is driven only by the hope that someone will buy it more in the future. That's what's called the greater fool theory of investing. For a cryptocurrency to be a successful investment, you must get someone to buy it from you for more than what you paid for it. That is, the market must be more optimistic about it than you are. Now that we have a fair idea of what are stocks and cryptocurrencies, let's talk about the pros and cons of both. Let's start with pros of investing in cryptocurrencies. Number 1. For most investors, the decentralized nature of crypto is appealing, since it is not controlled by any government or central bank who have the control over how much fiat they can print and induce inflation. Cryptocurrencies are deflationary in nature, and in many cases, the finite number of crypto tokens keeps them from artificial inflation. Number 2. Buying cryptocurrencies creates the potential for large gains on your investment. Several cryptocurrencies have seen their prices skyrocket since first being introduced. These gains are the main reason people are attracted to cryptocurrencies. But the potential for price appreciation comes with significant risk. Number 3. In the early days of cryptocurrencies, there were just a few coins that could be invested in. But the speculative interest has changed that. New coins are introduced regularly, and there are now thousands to choose from. Now, let's move on to the cons of trading cryptocurrencies. Number 1. There is no denying that crypto is extremely volatile. Since they are not backed by any resource or assets except stablecoins, the only factor adding to the value of a crypto token is the trade whims and supply-to-demand ratio. Fortunes can be made and lost quickly, and there's no telling where a coin might trade next. Number 2. Despite cryptocurrency enthusiasts touting the security benefits of digital coins, there have been notable hacks involving cryptocurrencies. It is often difficult to recover stolen funds. Number 3. Cryptocurrencies have no intrinsic value, which means they aren't backed by underlying assets or earnings the way that stocks are. Stocks have value because of their future earnings power and what they will return for their owners, while cryptocurrencies offer nothing of the sort. Number 4. The lack of regulatory laws and government-level acceptance of the crypto adds to the skepticism and volatility of the overall market. Although El Salvador has accepted Bitcoin, many great economies like China has banned all kinds of trades involving crypto. Which brings us to stocks. So let's talk about the pros and cons of trading stocks. Number 1. Stocks have a long track record of producing solid investment returns, with the S&P 500 returning about 10% over the long term. Though stocks can be volatile in the short term, they have generally been safe to hold over long periods of time. Number 2. A stock represents an ownership interest in a company, and its value over time depends on the success of the underlying company. Companies own assets that produce earnings and cash flow for investors, creating what's known as intrinsic value. Number 3. It is easier than ever to invest in stocks these days, with many online brokers cutting trading fees to zero. You can invest in individual stocks or choose to purchase a diversified basket of stocks through an index fund. Index funds help keep costs low, and you can build a diversified portfolio even if you don't have much money to start with. Number 4. Stock exchanges, brokers, and companies are all heavily regulated through various government agencies. Companies are required to provide certain information to investors through the Securities and Exchange Commission. No regulatory body is perfect, but stocks have been around for a long time, and there are certain investor protections in place. Now let's go over the known cons of investing in stocks. Number 1. Stocks are not a safe investment when volatility is a concern. When you hold a broad basket of stocks through index funds, stocks are less volatile than cryptocurrencies. Individual stocks can be more volatile, but typically less so than cryptocurrencies. Because of this volatility, stocks are best held as part of a long-term investment plan, so you have time to recover from any short-term losses. Number 2. The potential for extreme gains is low. Broad stock indexes like the S&P 500 likely have less potential for the extreme gains that can sometimes be found among cryptocurrencies. Stocks have returned about 10% over the long term, whereas it's not uncommon for cryptocurrencies to move 10% in a single day. I hope this gives you a clear picture of how risky or profitable crypto and stocks trading can be. These are not the only viable methods of investment, and at the end, it comes down to a personal choice for investors. Before we get into either stocks or crypto, make sure you understand the dynamics and study the assets you wish to trade. Seek professional help and have sound knowledge before you start.